All right, guys. So here we have our NQ chart pulled up. We are on the 5 minute chart. And what we're going to look at is some of these candlesticks and how they tell a story about a trend reversal. So this is a smaller time frame, but the same thing applies on larger time frames. And recently we haven't been having that good of price action, but I still want to show you how things can show up in these smaller trends. Like here, take this for example. Here we have a wick to let us know buyers were in, and then this green candle next to that, we couldn't get any follow through from sellers. And so what happens next is we get this run, we get this bullish run to the upside. And if you've been trading this for a while, or if you are a scalper, then you will have noticed that you will have used these two candles on the 5 minute chart along with the 1 minute to let you know what was happening. So this is what it looks like on the 1 minute chart. So here on the 5 minute chart, it doesn't look like much of a trade to take, but it actually is, because futures are highly leveraged contracts to trade. Not only that, if you were trading options or stocks and you trade in bulk or however you trade, whatever you trade, this is a good move. These are 5 minute candles. Remember, there's 5 candles in each one of these 5 minute candles. So if we look on the 1 minute time frame here, it kind of shows you a clearer story of the 5 minute, and vice versa. If you were trading on a 15 minute, 30 minute, or a 30 minute, 1 hour, 4 hour daily, when you look at the smaller time frames, they will show you the story being played out, and those are the time frames that you want to enter into your trades on. But as you can see here, this is the wick. This is what happened on the 1 minute chart that created a wick on the 5 minute. Sellers aggressively pushed them down with push price down with this big red momentum candle to the downside. Buyers immediately bought it back up. Sellers tried to sell it back down. They failed. Buyers came, kind of engulfed this candle. And then that kind of is a signal to go long. You could have waited. If it were me and I was scalping, then I would have waited for this cross right here that happened. As you can see there on the EMAs. That cross, that sucked. That cross right there is what I would have waited for. That would have been this is confirmation. When you traded for a while, but price rising above the 100-day moving average and finding support there, breaking through these two movement averages, coming back to retest the 21, and then finding support after the cross. Those are all confluences that will let you know to get in a trade. So you can wait for those confluences and have it'll be less risky, or you can get in here, and if when we come to test these, if we were to break back down, then you can get out. But then it's like, I mean, where do you take profits? Do you take it here when it finally breaks? And when it breaks, does it break too fast to where you come down and you stop even? That's all at the discretion of the trader. Sometimes people do that. They'll take the trade here, not for a scalp, but for the longer move, and they will have their stop somewhere probably below this level. And if it gets stopped out, they get stopped out. But this is a big risk for me. I like trades that are more that are less risky than that, and your risk is defined. So take this trade here for an example. Let's see what it looks like on the 5 minute chart, if that would have been a good enough trade for us to take. Let's see. Well, we have a small bullish divergence to the upside. Sellers stepped in, buyers could not follow through, and then we had a drop in price until we bounced right above the 100-day moving average. So if I were using 1 minute next to the 5 minute together, and I seen this on the 1 minute, I also seen that buyers couldn't push it through on the 5 minute, which we had that red candle, which would be, or that green candle, that smaller green candle, which would be this green candle here and this green candle here together. Once I seen that, that could let me know to get in a trade at the close of this candle. And where is our risk? Well, our risk is defined up here. So it's kind of what some people will call a cheap trade, right? Our risk will be the high above this candle. So we enter here, we're risking a couple $100 to potentially make, some thousands. And those are the trades I like to take. So when I'm doing well, those are the kind of trades that you see me taking, but I'm actually taking them based on the 5 minute. I'm taking them based on the 5 minutes and the 15 minute. And that's why they are quicker scalps for me. So that was a 5 minute. This chart right here is a 5 minute. This is a 15. So if I'm looking at the 5 on the right and 15 on the left, and I see that selling coming in, and I see this on the 15 minute, I'm gonna get in. And then again, where's my risk? My risk would be above. Here, let's do this. Let's do that so we can see it a little better. All right. So boom, there it is. I'm getting in. My risk would be above that high. Above that high. This candle, remember, we marked a high. And where is my target going to be? My target is going to be for if we break this candle high, then I'm thinking we could potentially come down and run this candle's low. That's the trade I would have taken. And the reason why is because wicks always get run. So I love those trades when wicks show up and prices going downward or upward. I know that at least the wick is going to get run. And so I know where to set my take profit, and I know where to set my I have a mental stop loss, and I know where that stop loss is. But sometimes with that, the whippy back and forth price action where all these where all these wicks just show up side by side by side, sometimes you have to let your risk be a little less defined, is what I have come to find out. But the bad thing about that is if you're wrong, you can get burnt really, really bad. But here we have kind of a long-legged doji where we were kind of indecisive. Buyers try to push it up, sellers try to push it down. We opened, sellers pushed it down, buyers pushed it back up, sellers pushed it back down. We didn't know what we were going to do. Here comes the big confirmation candle that we're going to go to the upside. You can enter in on this candle close and you take this trade to the highs. Now look what happens. Right when you take this trade to the high, we have a gigantic wick that shows up there letting you know price is soon to reverse. So what does price do in the next 5, 10, 15 minute? This candle, price reverses and we come down and we retrace about 50% of that candle. All right, so that's just some ways that you can use candles to identify reversals. And sometimes it doesn't always work, because here we have sort of an engulfing candle. These seem to be equal lows, but we have an engulfing candle, but there is no follow through. But that's why, regardless of how you're trading, even if you say you got that engulfing candle, it could be potentially that price is going to continue moving that way, but you always want to use other confluences along with them to make your chances of the trade playing out in your favor be greater. Okay, let's take a look at this. And so like I said, it's not always 100%. It doesn't always work. It's not just cut and dry like that, but for the most part, these things work. So this trade is one that I actually took, and the reason why I took it is because I'm watching the 1, the 5, and the 15. I see that there's buyers that stepped in on the 1 minute. All right. And when the buyer stepped in and prevented the sellers from pushing it further, sellers tried to come back in, but they failed. So at the close of this candle, somewhere in between the open of this next green candle and the low, I got in for a long and I got out up here somewhere. The reason why I got out is because I seen this red candle. The next green candle could not push higher than that red candle. So we kind of had these railroad candles. So I exited the trade because I knew buyers may fail to push it higher. And what did we do? We came back and we sold off. Now, if I was just looking at that trade on a 5-minute chart and I take this candle as confirmation, Look, it doesn't always work, but that's where multiple time frame analysis comes into play, because here is the 15-minute chart on of what is happening. So if I'm trading, if I see this on the 5-minute chart and I'm looking to scalp it, then I can use the 1 minute to scalp this price action from here, from the this is actually a hammer. But it's the wick that tells the story, but this candle is called a hammer. If I want to scalp, then I need to use the 1 minute and the 5 minute. We're not getting these real big moves or these trends. So I need to just know when price is going to reverse on the smallest time frame and what it's doing on a larger time frame. So on the 5 minute, if I look at this entire pattern that has this big red momentum candle to the downside, another big red momentum candle to the downside where buyers bought it up, it turned into a hammer, and a green engulfing candle that engulfed the body of the hammer, but it failed to run the highs um, of this candle here. So for me, what that's telling me is that this is a failed 3-bar reversal pattern and that we're not going to reverse. So if I see that, then I need to exit on the open of this candle. This candle opened red, it barely pushed up, it starts to sell down. I need to get out on the open of that candle. I know that, but but see, looking at the 5 minute, it looks hard. It's like, well, how do you know that? Remember, the 1 minute formed these two bars, these two railroad bars next to each other, where price could not get higher. They tried. Sellers tried to push it down, buyers tried to push it up. Buyers couldn't push it above the seller's candle, so we get out. What happens right after that? So price starts to fall on that candle right there. See, so on the 1 minute, we're watching the 1 minute, so we get out. If we're not watching the 1 minute, we got into a trade, and if we don't get out before price reaches our entry point, then we took a loss because price never returned back to the upside. But how do we know that? Again, we use the 1 minute, the 5 minute to scout. Another thing is we can look over here on the 15-minute chart. If we are looking to take this longer than a scalp, then first of all, we need to realize that this 3-bar reversal failed. And so we're probably going to come down. And the 1 minute chart says that we're going to come down. But if we're looking to take this again, like I said, maybe to run these highs and eventually these highs, then we need to make sure that we get some kind of confluence on this 5-minute chart, which could have been a 3-bar reversal. What we would have wanted to see is this green candle right here close strong above this white line and this red candle over here. What that would have looked like on the 15-minute would have been a dragonfly doji. So this is a bearish hammer, and it formed because it formed in a downtrend where buyers tried to push it up. So on the 15-minute, buyers pushed it up, but the next 15-minute candle, there was no follow through. After this hammer, the buyers did not follow through. We want to see follow through from the buyers on the 15-minute candle if you want to take that longer trade. So you need a confirmation on the 15 and the 5 to take a longer trade. The same way that we had confirmation on the 1 minute and the 5 minute to take this scalp of this candle. That's the way multiple time frame analysis work. You want to have confluences on two charts that you're watching the same, right? Because, well, for me, when I see confluences across two charts, I look for different things, then I know that there is a strong possibility that that trade is going to play out. And so I've learned to trade that way. See these wicks up top right here. You got wicks up top. You got wicks up top. You got wicks on the bottom. You got more wicks here, all the way down to there. You know, this is sloppy price action. There's a lot of buying and selling going on in those areas, and you want to stay away from stuff like that. You want to stay away. You want to let price settle. This, once we broke out on this candle, once we broke out of that zone, we came back to test it, and then buyers bought it up. And you see that we are holding support above the 9-day moving average, you could have actually taken that trade. That is a trade that you could have taken. So let's look for some more areas. This again, this wick let us know after this uptrend, right? It's sloppy because it's NQ, and this is just the way. Sometimes NQ charts are pretty, but for the most part, they're not. It's very tough to trade, but ES, which is a sister, gives some of these same moves, and the chart is much cleaner, and it's just not easier to trade, but it's much cleaner, and it's, I guess you can say, easier to spot because this lets you know sellers are here, and as you can see, it would have been a hard trade, but you know the sellers are here. We had a small bearish divergence. Bullish tried to push it up, bears pushed it down. We had somewhat of a fight. Bulls try to push it up here on this small hammer right here, this bullish hammer. We had a red candle engulf that. Same thing. And then the trade from here to here actually panned out and gave you money. Not only that, a lot of these patterns show up. Like you can see, it's kind of like a pattern. It's a U. So you know, it's like this swoop, 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 and then it drops. And when you realize that, you're able to say, oh, you know what? This thing is going down. That's why sometimes it's good to be patient. No, all the time it's good to be patient and kind of try to draw your zones like so. And remember, these are zones, so things won't be perfect. You know, I don't draw them all the time to meet the wicks. Sometimes when price action is just not being really friendly, I will draw this here, or that's when this rectangle box comes into play, and you can kind of mark your zone like that so that you know if we are trading in a channel, especially on a larger time frame, if we're just trading in a channel that price may come to here, but to remember that it is actually a zone and not, you know, a line. So as you can see, we rejected out of the zone, we broke through it, came down, traded above it, we came right back into that zone, bounced right out of it. And the way you trade that is, you know, you mark your levels like so, and you know we have a zone, so you're buying at the top of the zone, you're selling at the top of the zone, buying at the bottom, using candlestick analysis if you can, because at this point you will probably be on a 1 minute chart, and then when we break that zone, you take the trade. And if price breaks out, comes down to retest, bounces, you're good. If it comes back into the zone, you exit out the trade because we're not breaking out yet. It doesn't mean that you have to hold on and be upset about losing money, because one thing I will tell you is that price will continue to fall in that zone until it doesn't. So as long as you are able to mitigate your risk and hold on, then you'll either be able to trade within that zone or catch it the break to the upside or the downside when trading those zones. So there's a lot of things that I can actually teach you guys about this market, but I just wanted to get into the wicks, and somehow I'm turning this into a bunch of different ways you can find trades. Look at this channel. This is a beautiful channel right here that we broke to the downside. Actually, I think I took that trade. Yeah. What day is this? Yeah, I remember this. I actually remember this. But, and I think I took a couple scalps in the channel. But again, here, look. Again, this is going to be a zone. This is not going to be, you know, and this is a wide zone, but this is going to be a zone. You can say the zone is there. And then, you know, we're breaking the zone, having false breakouts of the zone, and coming back into the zone. So there, as you can see, that's kind of a little better. The bodies, see the bodies respecting that price area of that zone. Wicks are breaking through. Those are called false breakouts. So if you took a short here, it bounced back up on you, went back to the top of the zone. That's what price does, but eventually look what happened. You got a big engulfing selling candle. Buyers try to push it up. They couldn't push it up this time. Sellers came in and took over. But what I want you to realize is these wicks. See that wick at the bottom of that zone? So, okay, give me a second. Bear with me. There it is. See that? Look at that. That was a beautiful channel. That was a beautiful channel. I remember this. I would think I was getting chopped up at first, and then I realized we were in the zone. I got my money back. But as you can see on the 1 minute, when buyers kept pushing it up, I remember this, guys. I remember this. But here, guys, you can see that sellers try to push it down 3 times, and each time buyers stepped in. And this time, this last time, buyers would not allow it to get back to this low. And then we had a huge green candle to the upside, and we had follow through. But the indicator was this wick, which is on the 5 minute, and this is what we're seeing on the 1 minute. That's why when you're scalping this messy price action like this, it's good to look at the 1 minute and the 5. Well, it's always good to have multiple time frame analysis, but when prices like this, that's when I'm paying attention to the 1 minute, the 5 minute, and the 15. Other than that, I trade the 5, 15, the hour, and the daily. And when we have this kind of price action like this, you have to be aware of these kind of zones that we are in, so that if you're taking scalps, you know that where, if we bounce or if we reject, where we can go to. Price can get messy like this, and then I end up erasing everything at the end of the day. But that is a beautiful example of a channel that could have been traded, which had not dojis, but candlesticks with wicks in it. Here's a doji. Here on this candle that had no follow through of the sellers. Here's a dragonfly doji here. Let us know a reversal could be coming. Price went up, reverse, but those are smaller. Let's look for some bigger ones. Here, look at here. Right at the top, we have a long-legged doji. It's small, but it's small because this bullish divergence is small. But it let us know that there's a reversal coming. Now, the reversal could happen right away, or price could, go up for a few more candles and reverse, or it can go up for a lot of more candles and eventually reverse. Just depends on the market. It really just depends on the market. Here we have what's more like a shooting star. Same thing with the wick, shooting star. It came in at the top of an uptrend and then price reversed afterwards. These are, I love trading them. They're good indicators. Look at this. There was a lot of there was a lot of bearish sentiment in the market. We had a nice uptrend, and then we had a candle, inverted hammer that came in and said, no, we're not, sellers are here. We didn't get much follow through, but we had somewhat of a hammer here next to a long-legged doji, next to another shooting star, which are all bearish signals. We get a red bearish engulfing confirmation candle. We take the short candle. We wait for the next green candle, which is this one here. We wait for that candle to close. We see how it closes. We get in at the close for a short, right? So we get in there. We get in here at the close of this candle. And remember, green is green because price closed higher than the open. So we get in at the close of that candle. Our risk is right above the high of this candle. So if we run that high, trade is off. We're probably going to run these highs, and that's okay. We might lose a couple dollars, but we know that we know that that reversal is coming because this let us know. So if we were to go run these, then you just wait for another confirmation to get into the trade to the downside. So that is a good example of multiple bearish candles giving you signal that price is going to reverse, and price did. And guys, me, I'm a big like perma bear. I recently just am starting to be better at buying or going long. When you go long, that means that you're in for the overall upward price movement. When you go short, that means you're in for the overall downward price movement. So shorts is bearish, longs are bullish. And when I made my first 6,002 2 hours back in 2021, I believe it was. Yeah, 2021. It was a bearish market at that time, and I had no idea that that's what it was because I was new to the market. I was only like 6 to 8 months in at that time. I started in 2019, but I got away from it because the whole market crash is going to crash, and it spooked me, and I didn't understand a market crash was just a correction. And so at that time it was a bearish market, but I recognized that later on I recognized what it was is that I was just good at understanding when the market was going to go down, when we reached the top. That's just, I don't know why, it just came natural to me. And so months after that, I realized, actually probably a year after that, I realized, oh, I'm a great bear, because when the market started going sideways, and even when it turned around and started trending up, that's when I was just losing so much money, and I was make money and lose money. And then I'm like, oh, I have to figure this out. There's more to it, than just selling all the time, or there's more to it than just learning how to read the charts. And that's when you when you go through reading the charts and go through finding a strategy, you'll start to get into the psychology of it all. But that is a topic of discussion for another time. Look at this right here. This was a nice move to the downside. And again, guys, you want to look for other confluences. When you see things like this, use things like the MACD or the RSI. If you guys would like me to do a video on that, just let me know. But again, here we have a gravestone doji or a shooting star. And what do we have after that? We have a nice downward trend. We have a nice pullback. Actually, after a huge drop in price, we have kind of a W, and we retrace somewhere around 50% of that move, and then we have another pullback. How do we know the pullback was coming? Well, let's look at the candles. We have an inverted hammer right there. We have an inverted hammer followed by a long-legged doji, a green buyer's candle that barely pushed price above the inverted hammer, followed by a shooting star or a doji. We have a hammer next to that. We have another doji. We have a spinning top here, a spinning top here, a doji. Those are all bearish indicators. So guys, I hope you are starting to recognize that pattern, and you are able to use these I hope that you're able to start to see these things and understand how they play out in the market and how you can use them to your advantage. They're buyers, right? Everywhere. Buyers, 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 right? Price is flat after a downtrend. What do? We start to move sideways. The market is trying to make a decision. It's facilitating trade. People that were short are selling to people who want to go long. We got enough buyers to go long. We cross above the moving averages, we go long. This is the way the markets always play out, and you need to be able to interpret candlestick analysis to be able to again increase your chances of being correct about a trade. There's buyers. There's buyers. Sellers try to push it down. Those same buyers that were here pushed it up. So I hope you guys find value from this video, and I will see you in the next one. God bless.